Hello, this is Mike Swanson. I run the website WallStreetWindow.com, and the odds are that you're watching this video because you got an email from me telling you that it's up and ready for you to watch. Now, I haven't done uh, a video update in over a week, I believe, and it's because last week I didn't do any trades and we had the long July 4th weekend. But I haven't done any trades because I didn't really see any great opportunities last week. And that's what I want to talk about with you in this video. How do you actually buy in a bear market and have the trades work? Because we're in a bear market. And on Monday, July 4th, I put out an article showing that. And the reality is we're also in an economic recession. That's what the Federal Reserve data itself is showing us. Now, that's according to the Atlanta Federal Reserve's GDP Now estimates. They're estimating that in the second quarter, the economy is contracting over 2%. Now, it contracted in the first quarter in 2 quarterly GDP contractions. That's the definition of recession. And the stock market is essentially in a slow motion bear market. What that does is it makes it so there are certain sectors in certain stocks that lead to the downside. So when the market has a decline, they tend to fall worse than the stock market. And when the market rallies, they go up not enough to take back their losses. Owning and holding such situations creates what are essentially financial millstones in your portfolio. And the way to beat the market is to get involved in situations in things not doing that. So I believe what people need to do is use stock market rallies, and we recently had one, to sell positions that they own that are lagging the market averages. For instance, something such as Coinbase, a symbol COIN, is just going down, 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 down. So, in no coincidence, a lot of these stocks went up tremendously in 2020 and 2021 and became like meme stocks that people began to chase at with no valuation of the fundamentals, the earnings, the long-term prospects, the price being paid for the stock they're purchasing, and the stocks of companies heavily indebted and who are now having challenges with slowdown in the economy, growing debt loads, rising interest rates, making those debt loads more expensive. Those stocks are in the worst position. And some of the companies, these stocks, it would not be shocking to me if they do not go bankrupt in the coming years. That's not the entire stock market. So consumer spending is pulling back. And this is what Bitcoin has done this year. Bitcoin has had 3 leg downs in the market that were preceded by the circled areas in which Bitcoin went sideways. So elevator plunges, that really shake up the Bitcoin holders, but then periods of sideways activity, which brings out the predictions of the Bitcoin gurus for future gains. They tell the people to hold on, and then boom, the elevator falls, the trap door opens, and they get crushed again. This has happened twice. It looks like it's going to happen a third time. But the difference between Bitcoin and a stock with earnings and dividends is that the stock has a value to it. It can still fall in a bear market, but there's value in owning stocks that pay dividends in companies that operate in the real world versus the virtual crypto coins. And that's why in this bear market, in the stock market, the crypto coins are doing worse, and they're going to continue to do worse. And so are the most speculative stocks and sectors. And when we were in the bull market, when everything was going up almost every week, it was easy to buy something, have it go up, And there was a lot of talk of, hey, you just buy this, it goes up. You make money. People are sharing screenshots of their accounts. They're saying this will be the next thing to double and triple. But thinking like that now, is leading to losses. So you got to think differently when it comes to buying. You no longer can load up a Robinhood account and simply buy what everyone else is buying. You've got to think differently. And I want to show you how to do that in this video in a bear market. But first, I want to show you what my public portfolio is doing. You see, the idea of buying a stock and getting rich quick overnight is not going to work in a bear market. You got to think differently. You got to think about the goal being, I want to simply beat the market. You see, if you beat the performance of the S&P 500 in the long run, you're going to generate compounding wealth. And that's my part of my goal in these videos, is to get you to think that way, to abandon the hype and start to think more like a professional trader. So I started this public portfolio. I'm going to link to it. It's on tipranks.com. And I haven't done a single trade in it in several weeks, actually, since I established it. And that's what I'm about. Getting in positions where you don't have to jump in and out, jumping up and out, and try to beat the market that way, and make adjustments when you see changes in the overall trends of the market or a real opportunity. And it's just real opportunities and how they line up that I'm going to talk about in a moment. But first, this is the public portfolio, and I'm not getting rich in this. I started it at the very beginning of May, and luckily I'm able to beat the market because the S&P 500, it fell 8% in June, and in that month I was up 1.54%. And at the top is what the average performance of people on Tip Ranks is doing, and they're performing worse than the S&P 500 because they lost 10% in June. They lost more than that in April, close to 20%, 6% in February, 13% in January. And when you have losses like that staggered out month by month by month, they compound. And that's why lagging situations in the market are so damaging for people. You get smashed for a 50% loss in 1 year, you got to make that back. But if you think about, I just want to beat the market, not lose as much when the market falls, and just beat the market, they're not trying to get rich overnight. You've been trying to do that year after year. It will compound. That's how people like Warren Buffett, did what they did. Warren Buffett did not buy a crypto coin and get rich, in 30 days. It's not how it's not the real world and how this really works. But look, it's not like easy riches every single day. So in July, my public portfolio was actually down 0.74%. I'm not making giant returns, but I'm still beating the market. And that's my goal. I'm not trying to this is a bear market. It's time to be cautious. It's not get rich quick time. So my goal is to beat the market. So far, I'm achieving that, and to be up, not that much. I'm up 1% since May, but the average person is down over 10%. That's on Tip Ranks. The S&P is down, like 7 or 8%, and I'm up 1%. That's an 8%, close to 9% performance gap, or I'm beating the market. How many people on this thing are beating the market? I'm gonna see if we can find that out. But these are the positions I own in the account. DBA, an agriculture ETF, IU gold, RWM is an ETF shorting the Russell 2000. PSQ is an ETF shorting the NASDAQ. It's possible I'll make another trade before this month is over. SGOV represents, for me, a simple cash position. It's a fund, it's only moved, have gained 0.12%. It's a 3-month treasury bond ETF. Essentially, it's like a 3-month CD, the equivalent of, and 37% of the money is in that, because I want a good cash position in this bear market when I began this portfolio in May. It was not a time at the beginning of May to just jump all in on one trade. I need the flexibility that having cash positions give, and you can have that flexibility too if you simply sell millstone positions. If you own crypto, get out of it. Put that in cash to deploy when a better opportunity lines up. If you're in the ARK ETF, get out of that. If you're in something like NVIDIA that's badly lagging the market, get out of that. If you're in something like Coinbase, get out of that. Get out of that. Get out of laggards. Use laggards, transform them into cash reserves that can be deployed tactically when something lines up and when there's something to buy. So how do you buy? What do you buy? That's what we're going to talk about now. So let's look at a chart of the S&P 500. Now, if you don't want to own, you do not want to own the laggards. So you want to own the things that outperform the S&P 500, and you want to get an entry point. How do you do that? Well, this is the S&P 500. The chart on the bottom is a ratio dividing the price of the S&P 500 by the price of the S&P 500. Well, since they're the same thing, that ratio is 1 and it's flat. Doesn't mean anything on this chart. But if we go to something like the ARK ETF, we can see that that ratio is going down. That means if you divide the price of ARK by the S&P 500 every single day, chart it out, it's going down. Why? Because the price of ARK is going down relative to the price of the S&P 500. The ratio is declining. That means the relative strength of ARK, the performance of ARK when compared to the S&P 500 is downtrending. That means ARK is a laggard. This ratio tells me instantly that ARK is not something to own in the bear market. When the market falls, ARK falls more, and when the market rallies, it doesn't go up enough to take back its previous losses. It is the definition of a millstone in an account, needs to be eliminated. Coinbase, I mentioned before, same story. And there's lots of stocks like this. I mentioned NVIDIA, same story. NVIDIA, terrible laggard. In fact, even lagging now, worse than ARK, even worse than Bitcoin, because NVIDIA made a new low for the year and Bitcoin is just on that low. A little bit of a difference there. So we want things, we want to own things where that ratio is going up. So and that's why I own IAU in my IRA, my model portfolio, my main account, IAU. The ratio is going up. See, it's higher now than it was in June, in April, in January. It's going up. Gold is outperforming the stock market, despite the fact that gold has actually pulled back since March. And if we look at the price of gold, what we see is it's around 1,800. It went up over 2,000 when the Ukraine war started. Now it's given back those gains, and it's still up barely for the year, while the S&P is down about 20%, NASDAQ more than that. So, you know, but it could dip, it could fall. It's certainly not shooting up to the moon. And that leads me to, how do you get an entry point? Well, you could buy, you could average down with a money management system where you say, I'm allocating, let's say 10% of my account to gold. And if gold falls, so I'm now at 9%, I'll buy more to get back up to 10. That's actually what I do in my IRA. I got 14% of my money allocated to gold ETFs, IAU. Another way though, and this applies to sectors, is look in a bear market. This is a real reliable way to time things. If you don't just want to average down, but try to time things. Look for a dip in the market, a new low, a decline like we saw in June, like we saw in May, where the market falls for over a week, and then go back and perform the relative strength type analysis and look for something holding up while the stock market drops, and then getting ready to break out of some previous resistance level. Now you've got a good entry point. But for that entry point to line up, what you got to do is wait for the next stock market drop, and that it may not make the lows to August. It's not going to probably happen this week. It could, because it's such a horrible bear market, but probably the market will hold up, for the next few weeks, most likely. So you got to wait. You got to wait, and then let the market make that new low, the new next leg down, and then look and see what sectors hold up during that decline and get in a position where they can actually turn up. So that's what I'm actually doing, or my plan for the next month or two is to do. And if the market were to actually hold up here, it could, the S&P could go back up to 3,900 in the next 2 weeks. If that does that and things can hold in there, I may actually short more in that model portfolio. But we'll see what happens. If that doesn't happen, the market just dumps, then I'll be looking to do some buys in the coming weeks. That's my plan right now. That's how I'm playing things. Again, as that implies, don't look for a new trade for me this week. If you want new trades, you need to gamble, go on CNBC tonight, watch Fast Money or load up Twitter. Just wait. Someone will give you a pick. You can throw your money in that like it's a slot machine. That's not what my goal is. My goal is to try to beat the market. That means a strategy to employ, and I've laid it out, and I'm going to do what I say, and you can follow me along. If you like this kind of tactical approach, hit like so YouTube will know, hey, people do like someone that's trading and talking about a plan and not just throwing ideas out there. And if you want my next video update and you're new, hit the subscribe bell, and then hit the alert bell next to that, and then YouTube will send you an alert as soon as the next video is up. And all that said, I'll be talking with you later.